Did you know that you can buy a business for as little as 10% down, sometimes even less than that, using an SBA 7(a) loan? Well, in today's video, we'll talk about that and more. Let's get to it. Hey everybody, welcome to my channel. I am your host, Leo Landaverde, business broker and commercial lender, helping you buy and scale a profitable business. If you are a small business owner looking to increase your wealth by purchasing an already profitable business or competitor, or if you're a business executive or W-2 employee wanting to get out of the rat race by purchasing a profitable business, then you come to the right place. And I'm going to encourage you to subscribe to my channel. Don't forget to hit the bell and you'll be notified every time a new video comes out. Last year, back around September 2021, I did a video specifically titled How to Buy a Business Using an SBA 7(a) Loan. I'm not going to go into the same type of video. If you haven't watched that video, the link will be up here so you can watch it because it gives you a lot of the foundational context. I'm just going to talk about 3 different areas in which an SBA loan differs from a traditional commercial non-SBA loan. So it's important that you understand the difference between the two because it's going to be a big deal in how much cash flow you're going to have in the business. So key difference number 1 is amortization, which is also the length of time in which a loan is to be repaid back. So this is very key and pay attention. So I have some notes I'm going to be looking down from time to time. In non-real estate, SBA 7(a) loan usually goes anywhere from 10 to 15-year amortization versus the traditional commercial non-SBA loan goes 3 to 5 years. And think about it in this way. So if you ever bought a home and you understand that your debt to income ratio is going to be calculated, and if you get a 15-year mortgage, the payment will be substantially higher than if you get a 30-year mortgage. Same applies in business. If you get a loan to buy a business, well, first somebody's going to have to calculate, the underwriter will have to calculate the debt service coverage ratio, which is the same as the debt to income ratio when you're actually buying a home. And depending on the strength of the cash flow, which is the net income of the business, which will exceed at least 1.25 over the debt service, you're going to realize that if you're getting a 3 to 5 year loan, a non-SBA loan, the payments may be substantial depending on the type of the deal and the purchase price. So everything comes down to the purchase price. Let me give you an example. So say a business is doing $1 million in revenue, but you're buying it for 3 times cash flow. Say that you're buying the business for $600. So that say nets $200,000 or 20 cents on every dollar is net income. Hey, that would say that that's a very good business. So if you're buying it for 3 times cash flow, that would be 3 times the $200,000 or $600,000. So assuming that you're going to have to put a down payment, and if you're dealing with the SBA, it could be 0, it could be up to 10%. So you're tying up $60,000 of your own equity into the deal, so which means you're going to get a loan for $540,000. Now, think about it in terms of even with prime rate as it is as of June 2022, 4.75, and may inch up to 5. Now, an SBA loan will go caps at 2.75 over the prime rate. So if it is 5, if 4.75 and 2.75, you're looking at 7.5% rate of an adjustable rate. So think about it in terms if you were to amortize that over 3 to 5 years versus 10 years. So I'm not going to get into the math right now, but most likely it's going to be double the payment. So I will do a video next week. So you need to come back and watch that video in which I'm going to really digest with real-time businesses for sale, either on businessesforsale.com or BizBuySell. And I'm going to show you how to actually look at a business and look under the hood based on the information they're already giving you. So you can actually calculate the cash flow and you can actually run your own numbers versus how much down payment you can get. So, an SBA loan is just one way to actually finance a deal. You may be able to get a seller carry. Depending on the motivation of the seller may be willing to carry a note, which is a really great deal for you. So you don't just have to get a commercial loan or an SBA loan. You can actually get seller financing. But you need to understand that the traditional amortization from a traditional bank, it's going to be 3 to 5 years versus a 10 to 15 years. So that's going to pay a big deal in the cash flow. That's number 1. Number 2 is deal structure. So think of it in terms of this. The more flexibility, the less regulation. So when you're dealing with the SBA, either the 7A or the 504, you're going to be dealing with more regulation, more paperwork. It's going to be a full cycle underwriting, full underwriting type of deal. So the things that I'm going to talk about are not allowed in an SBA loan. So the buyer must purchase 100% of the equity of the selling shareholders or own 100% equity after buying the assets. So what that means is that you have to have complete and total control. So if you're going to personally guarantee this loan, you have to have complete control of the business. So in the event that you cannot be like a 20% shareholder or anything less than 51% control, you would not be able to get an SBA loan to get the deal, but you may be able to structure a deal if you have a couple of, say it's 3 of you buying a building and each one is 33%, you would be able to get a traditional non-SBA commercial loan. So you can actually bring more people to the table. You don't have to raise all the equity yourself. So, hey, I need a favor from you. If this video is resonating with you and you like the content, please do me a favor and like and comment on this video. You can go as little as a little comment or just an in-depth comment and I'll get back to you. But what it does is it allows you to serve this content to other people just like yourself that can also benefit from it. So thanks in advance for doing that. 51% or more, ideally the SBA would want you to buy the business 100% you, so it's 100% under your name. You'll control 100% of the shares. The number within this deal structure, when you're doing an SBA loan, that means that you cannot have no earnouts. The price that you buy the business must be fixed. Let me give you an example on what I mean on no earnouts. So there's a deal that from last year I was involved in. This was an electrical contractor in California with a purchase price of $3,550,000. This was a commercial electrical contractor doing a lot of business, had been in business for 20 plus years, solid book of business, year-over-year growth of at least 10%. They got a $3.2 million loan or 90% loan to value of the deal with a 10% down. So the business, the buyer had already a lot of experience in that and had other businesses. So he actually had the equity to inject. So the $350,000 to put down, this was a 90%. It was amortized over 15 years with working capital included. And take a look at this. It was a 2.75 debt service coverage ratio. There was no hard collateral in the deal. And it was actually at 6%. So it was prime plus 2.75. So prime used to be at 1% less than what it is. In fact, prime used to be 3%. And things have changed dramatically. That doesn't mean that this is not a time to buy a business. You just have to have enough cash flow to cover the debt service, which I get into the next point. So back to what I was saying, no earnouts. So if we bought this business for $3.5 million, that is it. So the seller doesn't have an opportunity to capture some of the deferred compensation that would have come under a traditional deal. It must be fixed. It cannot change. No contingencies added to the earnouts or royalties or extensive commissions to the seller, anything to drag that on. Think about it from the point of view of the seller. The seller sometimes may have a huge tax consequence beyond capital gains, at least 20% on capital gains, depending on how the deal was structured, whether you were buying the assets of the business or buying the shares of the business. Regardless, the seller will have a tax consequence. Sometimes if you do the earnout and it carries over, 2-3 years or beyond, 2 to 5 years, well, as the seller is receiving those cash payments, it'll affect their taxes for that given year, because when you file tax returns, it's on a cash basis. So if you haven't received the cash, you're not going to pay income on it, which would go away with an SBA loan. It would be like similar to when you're buying a house and you're buying with an FHA loan versus a conventional loan. So to think about it in terms, it'll help you understand. The next point is the buyer must have functional control, which I talked about a little bit ago. If there are investors backing a manager to run the company, the manager cannot generally be fired. So if you're coming in, you're going to come in with sweat equity or real equity in terms of cash. You're going to control 51%. You cannot be fired out of your own company, especially if you have a loan. So the SBA does this as a guarantor to make sure that you're not going to get a bait and switch. Somebody's going to come and buy with you and they buy, completely kicked you out of the business and be stuck with the loan payments. That would be a really bad situation. So it actually helps to have it this way. Number 3 is debt service coverage ratio. This is my favorite thing to talk about, and I talk about it just about every video. If you pay attention, if you watch my videos, I'm always obsessed about debt service coverage because that's my world as a CFO at large for multiple companies. I'm always worrying about debt service coverage ratios. So for an SBA loan, it could be as little as a 1.15. So 15 basis points over the debt service coverage. Say, simple math, if you have $100,000 a year principal and interest payments, so long as your net income is $115,000 for the year that is being tested, then you meet the ratio 1.1 over 1.5 over 1. Traditional financing is a lot more conservative. So if the SBA is not guaranteeing the loan and it's just a traditional, you're going to have 1.25 or higher. In fact, it is not unreasonable, depending on the risk profile of the business you're buying, to have 1.5 or more, just because banks want to make sure that there is ample net profit covering their debt service. And they're just not going to take your word for it. They're going to want your analysis as you're buying this business, but they're going to do their own analysis, which you imagine is going to be done by financial analysts to make sure that they're going to slice and dice that net income to make sure that it can stand the test of time, that it's going to amply cover their debt service. So just to recap, so this is the 3 things where SBA loans differ from traditional loans, commercial loans, and is amortization, deal structure, and debt service coverage ratio. Please, if you haven't subscribed to my channel, subscribe to my channel. There's a lot more videos coming your way about buying and selling of businesses. So if you're looking to buy a business, this is the channel to be. Thank you so much for watching. For a limited time, I'm giving away my cash flow calculator. This is a really great tool that will allow you to look at any business for sale right now and calculate how much net cash flow you would have post the debt service, which is very important when you're evaluating business and doing due diligence. It is my gift to you. Please click on the link below to download. Hope you enjoy it.